Have you ever wondered why some investors seem to succeed while others struggle despite doing everything right? The truth is, investing isn't always about making the perfect moves. It's about understanding the hidden challenges that can make or break your financial future. From the critical importance of starting early to the reality that no strategy works forever, we will be looking into some of the uncomfortable truths that can reshape how you think about your money. Without further ado, let's get started. One of the most crucial elements when investing is time, and its impact on your financial future can't be overstated. The power of compounding is central to this concept. Compounding occurs when the earnings on your investments start generating their earnings, leading to growth that accelerates over time. For example, if you invest $10,000 at the annual return of 7% in 30 years, that initial investment could grow to over $70,600. This shows how even modest investments, given enough time, can grow significantly. Starting to invest early allows you to harness the power of compounding fully. The earlier you begin, the more time your investments have to grow and multiply. This is especially true for younger individuals who have decades ahead of them to let their investments mature. By making contributions early on, the initial investment and returns on those returns grow, creating a snowball effect that can significantly boost your portfolio over time. Investing early also gives you the flexibility to adopt a more aggressive investment strategy, as you have the luxury of time to recover from any market downturns. Younger investors can afford to ride out market volatility, potentially leading to higher long-term returns. On the other hand, waiting until later in life to start investing can force you to take a more conservative approach, which may limit your growth potential. The longer you wait, the less time your money has to compound, which can result in a substantial difference in the final value of your investments. For instance, if two people invest $5,000 annually for 30 years, but one starts at 25 and the other starts at 35, the difference in their portfolios could be as much as $250,000 by age 55, even with the same rate of return. Many aspiring investors need help with the notion that they need a lot of money to start investing. This belief often prevents people from taking that first crucial step towards building wealth. However, you don't need a lot to begin your investment journey. Thanks to fractional shares and low-cost investment platforms, it's now possible to start investing with just a few dollars, even as little as $10. This misconception often arises from societal views that depict investing as something only the wealthy can do. As a result, many feel discouraged, thinking their financial situation needs to be improved for investing. But in reality, starting small is perfectly fine and can lead to significant growth over time. The key is to focus on long-term potential rather than the size of the initial investment. By shifting this mindset, individuals can begin to leverage the power of compounding, turning modest accounts into substantial wealth over the years. Now, to overcome the feeling of not having enough to invest, it's essential to prioritize investing. This may mean making small sacrifices, like cutting back on daily coffees or dining out, and redirect those savings into investments. Building the habit of consistent investing, no matter how small, is crucial. Also, setting up automatic contributions to your investment accounts can ensure that investing becomes a regular part of your financial routine. Market uncertainty is an unavoidable reality in the world of investing. Factors like economic downturns, political events, global crisis, and general market volatility can trigger apprehension among investors. This often leads to hesitation, where people hold off on making investment decisions, waiting for a more stable or favorable moment. The reasons for delaying seem quite persuasive. During economic slumps, many fear their investments will lose value, so they stay out of the market. Similarly, political events like elections or international conflicts can create an environment of instability, leading people to believe it's safer to wait until things calm down. However, this mindset can be counterproductive. The perfect moment to invest rarely presents itself. The real danger lies in the cycle of procrastination this creates. As time passes and market conditions remain uncertain, individuals may become even more reluctant to invest. This hesitation can result in a significant loss of potential wealth as the opportunity for compounding returns decrease the longer one waits. Less time in the market means less growth, which can severely impact long-term financial goals. Instead of viewing market uncertainty as a barrier, seeing it as an opportunity is more productive. Market volatility presents a landscape where risks and rewards are possible, and astute investors can use this to their advantage. For instance, market dips can offer a chance to buy undervalued stocks at a lower price, while periods of growth can lead to rising portfolio values. Understanding that volatility is simply part of investing can empower individuals to make smarter decisions. Rather than trying to time the market, a challenge even for experts, investors can focus on a long-term strategy. This involves setting clear financial goals, diversifying investments, and sticking to disciplined approaches, regardless of market fluctuations. Investing is naturally cyclical, with markets going through periods of growth and decline across different sectors. Real estate might experience a boom followed by a downturn. On the other hand, Bitcoin has seen wild price swings, and tech stocks often rise and fall with market sentiment and innovation trends. This cyclical nature tempts many investors to chase the latest trends, often falling into the trap of what's known as shiny object syndrome. It's easy to be lured into following a hot trend, especially when a particular asset class or sector is performing exceptionally well. But this approach is risky. Investors often buy into a trend at its peak, only to see their investments lose value when the market inevitably corrects. Take Bitcoin, for example. During its boom, many jumped in, only to face steep losses when the bubble burst. The problem with trying to time the market or switch strategies based on trends is that it can lead to emotional and poor decision-making. Investors might overreact to market changes, buying high and selling low, precisely the opposite of sound investing principles. The truth is, no single strategy consistently outperforms in all market conditions. Chasing returns often leads to disappointment. Given the cyclical nature of markets, the importance of diversification and discipline cannot be overstated. A well-planned investment strategy that includes a diversified portfolio can help reduce risks associated with market volatility. By spreading investments across various asset classes, stocks, bonds, real estate, and commodities, investors can cushion the impact of poor performance in any sector. With a consistent approach, investors will benefit from dollar-cost averaging by investing a fixed amount regularly. Regardless of market conditions, investors can buy more shares when prices are low and fewer when prices are high. Over time, this lowers the average cost per share and improves overall returns. Market ups and downs are a natural part of investing, and experiencing a downturn is simply a part of the economic cycle. Throughout history, markets have seen both expansions and contractions, with periods of falling asset prices causing concern among investors. It's easy to worry that a down market signals an impending financial crisis. Still, it's crucial to understand that these downturns are not only expected, but necessary for a healthy financial system. Market corrections, typically defined as a decline of 10% or more from recent highs, happen regularly and can be triggered by various factors, such as changes in economic data, geopolitical issues, or shifts in investor sentiment. While these downturns might feel unsettling, they often serve an important role by bringing asset prices back in line with underlying economic realities. After a long period of rising markets, a correction can help reset prices, paving the way for more sustainable future growth. History has shown that markets tend to recover over time. For instance, After the significant declines during the 2008 financial crisis, the stock market eventually rebounded and reached new highs. Recognizing that market fluctuations are a normal part of investing can help investors keep a long-term perspective and avoid reacting emotionally to short-term volatility. Being prepared for market downturns is essential for financial stability. So, to weather these fluctuations, you can maintain a stable income and build an emergency fund. An emergency fund, ideally covering 3 to 6 months of living expenses, provides a safety net during unexpected events like job loss or medical emergencies. This cushion can prevent the need to sell investments at a loss during a downturn, helping to preserve long-term financial goals. When the market is on the rise, it's easy for investors to feel they're making all the right moves. This sense of confidence can be misleading, leading some to believe their gains are purely the result of their own savvy decisions rather than favorable market conditions. However, this overconfidence can be risky. It might cause investors to take on too much risk or make impulsive decisions, thinking they've mastered the market. Temporary gains during a bull market can give investors an inflated sense of confidence. They may start believing they've timed the market perfectly or that their strategies are foolproof. However, this mindset can cloud judgment and lead to poor decisions. History shows us many cases where overconfidence during a rising market ended in significant losses. The dot-com bubble of the late 1990s is a prime example. Many investors thought they couldn't lose as tech stocks soared. When the bubble burst, many faced devastating losses, showing that market conditions, not individual skill, often drive short-term success. Overconfidence can also lead to a lack of proper risk management. Investors might skip diversifying their portfolios or neglect setting stop-loss orders, assuming their winning streak will continue indefinitely. This can have catastrophic consequences when the market turns, underscoring the importance of humility and caution. To navigate a rising market, keeping a cool head and thinking long-term is crucial. One effective strategy is reinvesting gains rather than letting temporary success lead to increased spending. Reinvesting profits helps compound returns over time, maximizing the benefits of a rising market. This disciplined approach boosts portfolio growth and keeps the focus on long-term financial goals. So, by maintaining a long-term perspective, you'll avoid the temptation to splurge based on short-term success. Gains might make investors feel like indulging in lavish purchases, which can undermine financial stability and lead to regret. Instead, it's wise to reinvest some of the gains and allocate some to savings or responsible spending. This balanced approach allows investors to enjoy success without risking their financial future. So, which of the truths are you a victim of? Let us know in the comments below. If you found this video helpful, give it a thumbs up, subscribe, and don't forget to turn on the notification bell for more amazing videos.